Hi, and welcome to our weekend Q&A marathon where we talk macro, try to make sense of markets that, they don't really make any sense, but more importantly, answer your questions today in part 2 of our weekend marathon. Let's just get right into it. Oh, by the way, I'm your host, Steve Van Metre. Thanks for being here today. And if you didn't get your question answered this week, today is your day. All right, let's start out number 1 on deck. Firstly, thanks so much for your podcasts and videos. I was recently introduced to them and find them very helpful. Well, you're very, very welcome. I had 2 questions relating to your most recent video posted 8th of June, I believe. Well, that's okay. I don't remember either. You made a point in the second half of the video that as interest rates or yields drop, stocks would fall as well. Why is that so? I thought a drop in rates would make stocks more attractive and cause the discount rate to value of stock decrease, causing valuations to rise. Biggest misconception in the markets. Let's do a chart. 10-year treasury yields. Let's overlay the S&P 500, and we'll zoom out. And you can see when yields fall, stock prices fall, stock prices rise, yields rise, they fall and generally rise together. And when they become dislocated, as we see right now, very obviously, then we get what are called the jaws, and jaws eventually have to close. But another way to look at this is on the 13-week treasuries. You can see as yields fall, stock prices fall, and even though they were suppressed by the Fed, they would have naturally risen, and now they're falling, suggesting stock prices need to come back to reality. So that is a long-term relationship. It exists due to our monetary system. And let's get back and see what your question is. So when yields are falling, it's a sign of deflation. And that's something a lot of people don't understand. They think low yields are inflationary. They're not inflationary until they trigger an increase in lending demand. So what are we seeing right now in the data? And if you're brand new to the show, thanks for being here. Go watch Friday's video where I talk about the credit data and what do we see? We see a contraction in the credit data. So yields are not low enough to cause inflation. So lower yields are deflationary until they are inflationary, and rising interest rates are deflationary until they become inflationary as they rise to absorb lending demand. It's confusing. You can't just say rising yields are inflationary. They are, but not until they become inflationary. So what do I mean by that? Well, this recent rise in interest rates right here in the 30-year-olds was not inflationary. Now, rising yields are inflationary, but only when they're rising due to an increase in lending demand. And there wasn't. In fact, lending demand decreased. So they became deflationary, and now they have to come back down. And my guess is they are not low enough yet to trigger inflation until they're going to be, well down here somewhere. So that is something about monetary policy that is often confusing, but the relationship between stocks and bonds is very simple. Let's get the arrows out. When stocks and yields, they go down over long trends together, and stocks and yields, they need to also rise together. There you go. Okay, next part of your question. You mentioned you are positive bullish on the bond market. I am relative to the stock market. Oh, I am very, very bullish. Insanely bullish. I wanted to understand why, given interest rates are so low and there is limited room for them to fall further and consequently for bond prices to rise. Can you provide more insight into your thinking? I can, because we're in a deflationary environment. And what happens during deflation? Asset prices, if stocks are an asset, they go down. And also interest rates go down. So if stocks are going to go down and I'm invested in stocks, what's going to happen to my money? I'm going to lose it. Well, even though maybe yields aren't far from zero, which we are assuming is as far as they can go, which may or may not be true because we don't know. But if yields were going down, what does that mean for bond prices? Well, that must mean we're bullish. So my option is I can either be bullish about something that I know has an exceedingly high probability of going up, or I can be bullish on something that I believe has an exceeding high probability of going down. I'd rather be in bonds. All right, next, just for the sake of being a devil's advocate. Okay, I like it. What would a scenario of inflation flat versus deflation look like for the markets? How could the Fed Treasury cause a flat scenario where it doesn't deflate nor inflate significantly? That's really, really easy. They just have to keep the money multiplier level. So as the money supply decreased, then the Fed would have to decrease their monetary base by tightening, and so they just have to kind of balance it out. As the M2 rose and fall, they'd have to keep the monetary base as close in line with it as possible. Not going to do that, but theoretically they could. It would be very difficult for them. Another question, if I may. You say that the Fed can't print money. They cannot. But that seems to discount the Fox merging of the Fed Treasury BlackRock. Why, in your view, does this combo, having access to Treasury funding and the consumer market, not make a difference? Well, it is in a gray area. It is technically the money is a loan that will have to be paid back. But this is the farthest we've ever seen the Fed go into the gray area of money printing. I believe this is where they will stop. I don't believe Powell will want to go farther. This is not really his game. I don't think he feels comfortable with it. But this is as close to what money printing can look like that it does. But it is not because it's technically a loan. So until it's not a loan, it's still a loan, and it's in the gray area, and it's just a gray area. It's close. Very, very close. Hi, Steven. Another question for you. Hey, back at you. You got it. What do you got for me? If interested, stay near zero bound. Do you believe the mega large cap companies with good credit scores and borrowing as much as they can from the banks for stock buybacks and takeovers of insolvent competitors currently? Oh, if interest rates stay near the zero bound, do you believe? Okay, I was like, wait a minute, I'm obviously misreading something. If interest rates stay near the zero bound, do you believe the mega large cap companies with good credit scores and borrowing as much as they can from banks for stock buybacks and takeovers of insolvent competitors currently? Now, if they were already doing so, wouldn't that justify their current price as they would come out of this pandemic almost as a monopoly? Would love to hear your thoughts. Thanks. You got it. So here's what's going to happen. In a deflationary environment, the cost of debt goes up. Like, what do you mean? Cost of debt goes up? Well, the cost of debt relative to your income. So a corporation is going to have lower earnings, lower profits, lower revenues. That's what deflation is. Now, let's just assume none of their debt changes. So their income is going to go down relative to the amount of debt, their debt service. So it's going to be a problem for them. Now, if their debt is maturing and is maturing at higher interest rates, well, now their cost of debt is going to go up. Now, if you're a banker and your customer who has a lot of debt is watching their profits and their ability to repay that debt go down, what do you generally do? You tighten credit and rates go up. In deflation, commercial rates, not treasury yields, commercial corporate yields go up. They go up. Ooh. So no, this question is great if it assumes that corporations are borrowing at treasury yields. They're not. They have to borrow in the corporate bond market. In deflation, there's less money floating around to begin with. And why would a borrower want to lend as much money to a company whose debt to income ratio is off because their income is falling? Well, they're not. And if this company wants to borrow, well, the borrower is going to charge them more money because there's the risk premium is going to rise in terms of the lender's ability to get their money back. So, yeah, you would think that it could. If the big, companies like, say, Apple could borrow at, the 30-year rate, if it gets zero, like I think, or near zero, yeah, you'd be an opportunity. But they don't. They borrow at the corporate bond market rate, and that should go up. All right, next. Could you share how you figure out where the supply lines are when you're looking at the bond yield chart? You may have bond yield levels noted on your TLT chart. What is the significance of, and how do you create the various levels you have noted in the horizontal lines? Now, I covered a lot of this on Friday, but I did not cover how I draw the lines. So let's go and pretend to draw some lines. So we'll go to TLT, and let's zoom out because I don't have a lot of lines here. So how do I find a supply line? Well, I need to find a place kind of like Translex Traveling Music, where Niles and Monterey once it's still intersected, but Translex Traveling Music doesn't intersect there anymore. And back when I was in high school, and that was a pretty popular commercial in town, Translex Traveling Music. So let's zoom in here. I didn't get any traveling music from them, but they were very popular. So how do you draw a supply line? Well, here is an upper end of a bound. So I'm going to duplicate this, and I'm going to look for, say, the lower end, which is going to be right here. Now, how am I going to know that? Because I see a price chart coming up and tagging a zone of, well, this would be a support zone, or reverse bottom up, it's a resistance. So here's a supply zone. And then I'm going to need to draw some more, because this is where the sellers were at. Where were the buyers at? Well, the buyers were clearly down here, because we could see where they were. I mean, buyer, 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 right? So they're buying down here, and they're buying in a range. So we'll say they're buying between, I don't know, maybe, yeah, maybe here. No, not that high. They're buying down in here. There's actually another supply zone kind of right in the middle. They're not as close, or they're not as far away as those that are in there. But you've just got to look and see where the buyers are at. We know they're down here somewhere. We can see them buying, and where the sellers at. Actually, now that I look at this a little bit longer, I think the buyers are very narrow here. And let's see, the sellers are maybe a little narrower. And then I think there's another one right in the middle here. And some of this is just feel. You just got to look at the chart and kind of figure out where everyone's playing at. And that's all you're doing, is you're just trying to figure out where the buyers are at, where the sellers are at. I'm not confident on these middle lines, but anyways, I'm relatively more confident on these top lines. And then as the chart progresses, you can kind of adjust your lines a little bit. And if we go down here, we can see buyers were down here. There's another supply zone that ended up here, and this supply zone is validated because it held up. There is another channel right in the middle here, maybe just a channel, a very narrow one. And up here we saw sellers, 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 and then it came up here selling, and then the last time it broke through. So that we do know this was a supply zone of sellers, and we know down here was a supply zone of buyers, and there's all kinds of messy stuff going on in between. And that's kind of how you do it on a chart. And you can really do it on any chart. It doesn't really matter. We can go to one that I have nothing on. Here's, say, small caps, and you can see here sellers are right up here. So let's go and draw, let's see, price level. So here we know, whoops, sellers are up in here somewhere. And we know for a fact the buyers are right in here. You can see them all. There we go. You can see buyers. Why do we see buyers here? Look, buy, 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 buy. Prices are going up. And then the zone is probably somewhere right about there. And then there's some stuff in between, but you can get a feel for kind of where these supply zones are at. And it's just something you have to do with practice and by feel, and it evolves. As the chart moves, you get more confident about your zones or less confident. So on TLT, for example, where I've drawn these in, when the chart initially moved up here, I wasn't really sure. It took time to let the chart evolve to see it here, and then to come back and re-add this one and say, okay, clearly this is where the buyers are at, this is where the sellers are at, and you can find this virtually on any chart. So it's just something, like I said, it's like anything, you got to practice, you got to read the charts, the tea leaves, however you like it. Next question. Say I buy a stock share for $10 and sell the next day for $11. Did I just participate in increasing the money supply by $1? No, you did not. Because you have to assume that when you bought it, someone else sold it, so there was a net transaction of nothing, and then you sold it and someone else bought it, so there was a net transaction of nothing. So in order for you to increase the money supply by the dollar, someone else had to decrease it, so the net transaction was zero. Now let's say you withdrew it out of your brokerage account to buy a hamburger. Did I just put that newly created dollar into circulation? Yes, you did. I've read that when stock market tanked back in March, that all this wealth disappeared. So does it reappear? Well, you got to understand, it was a lot of this on it's paper wealth. There, until something is sold and withdrawn, it's just on paper. It's like the equity in your home. I mean, it's until you do something with it, it's either bragging rights or maybe not. So does it reappear when the markets go up? Yes, it does. That's because whatever the next highest price raises the price for everybody. but not everybody sells. That's really the key of the market. If everybody sold, then we would find out that prices are not what they are now. Is this what you mean when you said the Fed is trying to get us to do its job for them? Yes, what the Fed wants is effectively us to buy stocks, get asset prices to rise, take some of that money out, spend it out in the real economy, which then in turn create money by, because we need to go to a bank to borrow money to create more money. Then some of that money would get back into stocks and keep pushing it up. And then we get the cycle going, and then we start buying a lot of foreign goods, and then the world all liquidity cycle would get restored. So yes, the Fed wants us to do it because they can't. They don't have any mechanism or ability to do that. I think this may be a dumb question, but it seems important. There's no dumb questions on this show. So it was important. Thank you for asking. Next, you've convinced me that when the Fed purchases bonds for bank reserves, it's not printing money until the banks do something with them, and they can't touch them since they're held in reserve. That is correct. However, when the Fed purchases newly issued Treasury notes to fund the deficit, isn't this money printing? No, because the Fed doesn't purchase newly issued. They can't. The Fed does not. So we can kind of negate the rest of this question is because the Fed does not purchase from the Treasury. There's only three people that show to Treasury auctions. There are foreign bidders, domestic bidders, and that is not the commercial banks, and securities dealers. Now, the securities dealers, which happen to be owned by the commercial banks, but they're not commercial banks, will sell that debt typically to the commercial banks, who in turn sell it to the Fed. So the Fed does not participate in the U.S. Treasury auctions at all. So that is why it is not money printing. The Fed can't spend, the banks can't touch the reserves, but we all know how well the Treasury spends. Well, it's more correct is how the government spends. Do you see an inverse correlation between bank stocks such as BAC and bond ETFs like TLT? How close is this correlation? That's a pretty interesting one, actually. Let's take a look. So we'll go and look at XLF, and we will compare with TLT. And lo and behold, if we move and zoom out, looks pretty inverse to me. Now there's a better way to look at this, and I will show you. If we overlay it, instead of TLT, let's do Treasury yields, TNX. Aha, does that make more sense? So as yields rise, bank stocks rise. As yields fall, we knew bank stocks were going to fall. So bank stocks are trying to rise against falling yields. Guess what? When yields are low, and think about it, do banks make a lot of money when yields are low? No. Do they make more money when yields are high? Yes. And you can see this relationship is generally pretty good. So, and as yields go down, bank stocks peaked and eventually rolled over. So, yep, banks make more money when interest rates are higher, less money when interest rates are lower. So how close is a correlation? It's not tight, but we'll call it a relationship. And when you see both go up in the same direction at the same time or both go down the same direction at the same time, what does that tell you? It tells me something is wrong. Bond prices and bank stocks generally do not move up or down together. It tells me it's a short-term dislocation. Steven, your hypothesis is based on the bonds going up in value. Okay, I'm not sure what hypothesis we're referring to, but maybe it'll make itself apparent. But in March 2020, we saw bonds go up quite a bit. All right, well, let's go and look at that. So we're all on the same page with what the question is. So bond prices, March. Wait, sorry, what? I already forgot the question. Let's see. March when bonds go up. Yes, well, that's because they went down a lot too. There was a liquidity event that caused prices to go down, and then they came back up. But they did go up quite a bit. So, all right, now back to the question. How do we know that this was not the move you predicted? The move is over. Oh, the lending data tells us. So until lending growth comes back, the yields have to continue. Great question. So interest rates have to continue to fall until it spurs lending demand. That's the key. So if lending demand continues to shrink and contract, then interest rates are too high. Simple. So that's why we look. Like, a lot of people don't look at the lending data. And my friend Dr. Chris Dark, today's Friday as I record this, he posted on Twitter today. He says 99% of people don't look at some of the most important data that's printed every week. And it's why we look at it every week, because it tells us the answer. It tells us everything. So if interest rates are low enough to spur lending growth, then we know that we're going to see inflation. But if credit conditions continue to decline and contract, then interest rates got to go lower. That's the bottom line. Why would we expect more than this? And if we expect more than this, then the high point and low point on the TLT in March, are you saying that in the macro 3-year hold strategy that you expect TLT to go higher? I don't know where the 3-year hold strategy comes from, but if I said that, I don't know why I said that. That you expect TLT to go higher by this a lot. So the simple answer is, do I expect interest rates to go down more? The answer is yes, and that should cause bond prices to go higher. That's the question. I can't refer to a specific security in too much detail. If so, that supports your hypothesis. And if not, or not confident it will, then how do we know that this move isn't already over? Does lending demand tells us already spent? Nope. And if it can go higher, how much higher in relative terms? What is the maximum potential for bonds to go up in this macro? And I cannot answer that question. You'll have to look at how far lower you think yields go and how high up whatever the security is you're buying could go based on its duration. And if you expect a huge move unlike anything we imagine, wouldn't it be wise to wait until confirmation of this move and we see bonds go way up higher than the previous peak? I do expect them to go higher than the previous peak because I expect interest rates to go lower than the previous low. Using technical analysis strategy around momentum confirmation, I don't know about momentum. I don't know. Some of this is just a feeling that I have backed by data. So, I mean, the technical analysis will help. Momentum will be rapid and short, so we'll see. I'm having trouble imagining the kinds of confirmations that prove the hypothesis is going to happen in the future and hasn't already been spent. Well, look at the credit data in Friday's video and go back and do some of your own research on it. It tells you everything you need to know. Spent mean the move already happened while we were sleeping. Now it's too late. I don't think so. Explain to us what lagged CPI means and how investors use this for macro trading. Thanks for the content, Steve. You're welcome. Lagged, okay, so the CPI is just a lag data point. And all it means is by the time the CPI is released, all the current data, the more micro data that comes out already tells us what it's going to do. We already know. So it shouldn't be a surprise that when the CPI goes up or down. I mean, sometimes there are going to be surprises, but the data that feeds into the CPI is old news. That's why it's called a lagged indicator. So it falls behind the curve. Thanks again for all you do. You've done so much for me and my family. Looking forward to the Q&A. Awesome. Well, here it is. When bond yields rise before the big crash equals 10 years, do you expect equities, the S&P, to rise alongside bond yields? Then, do you expect S&P to crash alongside bond yields on their way to negative territory? So I don't expect bond yields to rise before the big crash. There's nothing that's really out there to drive yields higher. So do I expect equities to rise alongside bond yields? No, I expect equities to fall. Then do you expect S&P to crash alongside bond yields? Yes, because again, the relationship is very simple. It is a long-term relationship that stocks and yields go down together. They can be dislocated for a while, but one of them tells you the truth. Well, we can look at the credit data and we know what the truth is. We can look at the money multiplier. We know what that says. We know what the Fed's easing. That's going to drive the money multiplier lower. But eventually yields will go up because guess what? The big players will sell them. People who own them will wait till they drop to a certain level, and a bunch of them will end up selling them, and that will cause interest rates to go up. Now, will it be a long-term play? No, but it will actually be a play, drive yields up, and then they will eventually head back lower because yields don't fully bottom until after the recession or depression is over, because it takes that long for balance sheets on households and corporations to recover enough to start borrowing again. All right, love the videos. Hey, thanks. Thanks to you, I finally feel like I have a bit of clue as to what the Fed can and can't do and the effects of their actions. That's pretty cool. On to my question. If I understand correctly, you're using bond yields as a leading indicator for where the market is headed. That is correct. Yields are down and you expect that stocks will fall to meet them. The jaws must close. Correct. However, as I understand it, the Fed is buying a ton of treasury bonds. Yes. Wouldn't this be driving yields lower than they otherwise would be? Well, yeah, the answer is yes and no. Now, on Friday, we looked at how I believe that there isn't enough supply of 30 years new 30-year debt being issued for the Fed's rapid appetite for long-term bonds. However, on the shorter end of the curve, it appears that there may be more than enough short-term debt being issued because we're running massive deficits. So the answer is it depends. Now, in this case, I do believe that QE will not just suppress, but drive long-term rates lower, which we need anyways, because when you look at the real estate lending data, which is super critical in the economy, it's about to contract on a 3-month basis. It doesn't do that very often. In a debt-based economy, you do not want lending growth to contract ever. Ever. It should not do that. In a debt-based economy, you need a constant, continuous expansion of debt. So when it starts to contract and you see it in the data, you go like, oh no, that's a problem. And that tells us that interest rates need to go down. Why? To get people who have equity to go borrow it and spend it, which I'm not going to do, but that's the idea, is they need to get people to pull equity out of their homes, go out and buy new homes, and the only way that's going to happen if interest rates are lower. So so the Fed buying a 10 Treasury loans doesn't necessarily end up driving yields lower, but it can. It's not a, does that kind of make sense? It just depends on the situation. Now, right now, the more QE they do, the more likely it's going to drive yields lower. And I think we're doing enough, especially on the long end of the curve, to drive long-term rates down. And apparently on the short-term side of the curve, they're keeping yields fairly flat. Now, how do we know that? Is we can go look at the short end of the curve, the 13-week Treasury, not budging. It's at 0.15%. And 5 years, pretty flat. So we know there's enough QE on the short end of the curve. And what we're finding out is while there's no increase in QE on the long end of the curve, what we do know is the issuance is below, or the new debt issuance is less than what the Fed's buying, which tells me that the long end of the curve could be actually driven lower by the Fed. Does this distortion undermine the value of yields as an indicator? No, not at all. Because when yields go down, it causes deflation, and that brings stock prices down. That is why we had such a big crash in 2008, is because the Fed effectively shoved interest rates lower, created a massive deflationary pulse through the economy, and blew things apart. Other than perhaps the fact that the Fed is buying bonds, also a sign that economic conditions are such that the markets will come down. No, the Fed buying bonds, here's the problem, is QE doesn't actually do anything in the economy. It really doesn't do anything. So the Fed is just doing it to get people to believe that it does something because people believe it does something. Look, if everyone was convinced that QE didn't actually do anything, which it really doesn't actually do, the Fed would come up with something else and call it something else and do it because people would believe in it. And they do enough of it until somehow people believed enough that they went out and spent money, and then they could say, oh, look, the Fed came out with the QPY strategy, and man, that just drove equity prices up. So every time they do QPY, well, we'll just buy stocks and spend money. That's kind of how it works. But it is, obviously the Fed doesn't do QE when things are great. So it is a concern, and we obviously know that based on Powell's recent press conference. So I think you're kind of on track here with this question. So yes, the Fed inadvertently, by doing QE and driving yields lower, crashes the economy. That is what is so amazing. When you finally get that and understand that the Fed actually crashes the economy by trying to ease monetary policy. When you get that, it blows your mind, blows your whole thought process on what the Fed does. And with that, we'll wrap up and call this the end of part 2. I'm Steven Van Metre. Thanks for watching. We'll see you on Monday. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by or selling security and financial instrument or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity and opinions expressed in this video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.